Hi again. In this video, we will be talking about some of the alternatives, some of the techniques to evaluate alternatives. So we use the economic and non-economic based on the public opinion, but economic would be if this alternative is feasible, how much will cost, how soon we will have it, what will operating and maintenance costs will be, what would be the useful life for that alternative. Will it be compatible with the present personal and present operations? So these are the things that we should consider. And we're going to focus on economic in this chapter, and we could talk about different techniques such as the cost volume analysis, the financial analysis, the decision theory, waiting line analysis, and simulation. There's so many, but for us in this chapter, we're going to talk about just the cost volume analysis, which is talking about finding the fixed cost, the total cost, and break-even analysis. And briefly, we'll be talking about just financial analysis as a one way, but these are out of the scope of this class. You could read about it in more details. All right, so talking about the cost volume analysis, this is a technique focusing on relationship between cost, revenue, and volume. And the fixed cost, these are fixed, that doesn't change with the outcome. It's stay constant. Variable cost is vary with the output. So the more units you're producing, the more cost you need. The more customer you're serving, the more cost is needed. And the variable cost will be calculated by quantity times the variable cost. Total cost is equal to the fixed cost plus the variable cost. And the total revenue is total revenue per unit, which is how much you sell the unit, the sales price times the quantity. And there's this an important relation between the total cost and total revenue, which is called the break-even point. The break-even point where the volume of output at which total cost equal to the total revenue. So whenever we have the total cost equal to the total revenue, and that would be the break-even point. That point, if you reach the break-even point, you're not making money, you're not losing money. Basically, you're covering only the expenses that you pay. In order to calculate the break-even point, you could do the profit to be zero here. So we zeroed the profit equal the total revenue minus the total cost. And then we solve the equation for X, which is the quantity. And that will give you this equation. The quantity for the break-even point would be the fixed cost divided by the revenue minus the variable cost. In order to demonstrate the break-even point, here's this chart will help you. So that would be the total revenue. And here's the total cost. The intersection between the two lines, that would be the break-even point. So if you exceeded that point, that you will be making profits. If you did not exceed, if you're behind that point, that means that you're losing money. So what we need to do is to take an example on calculating the break-even point. So we have this example 3, which is the owner of old-fashioned berry pies, as Simon is contemplating adding a new line of pies, which will require leasing a new equipment for a monthly payment of $6,000. Variable cost would be $2 per pie, and pies would retail for $7 each. How many pies must be sold in order to break even? What would be the profit if sold 1,000 pies in a month? How many pies must be sold to get a profit of 4,000? If 2,000 can be sold and the profit target is 5,000, what price should be charged per pie? Okay, so what I want to do is I'm going to move this to Excel so I could share with you my Excel how we could solve. All right, now we're back here and let's share my screen with you. All right, so we have summarized the data from the question. Fixed cost is 6,000, variable cost $2, revenue or the sales price is $7. To break even the point, we use the equation, which is the fixed cost, the 6,000 divided by 7 minus 2, the revenue minus the variable cost. And that will give you 1,200 pies per month. For part B, what would be the profit if we sold 1,000 pies? So that would be The target is 1000 pi. So we find out the profit using this equation, total revenue minus the total cost. So that would be uh, this one here, which is the revenue of $1,000 times, we're making a profit of 5 here, which is the F8, the 7 minus the 2 minus the 6,000, that's the fixed cost, and that will give you a negative, they're losing a $1,000. Now for part C, which is how many pies, if they we need to make a 4,000 profit. Again, the profit is equal to the total revenue minus the total cost. We have 4,000. The total revenue would be X times 7. That's how much the sold price, minus the 6,000, which is the fixed cost, minus the 2X, which is the variable cost. And solving this equation for X, you will have, in order to make $4,000 on profit, we have to sell 2,000 pi. And the last thing is for profit for part D, if we're trying to make 5,000 as a profit and we can do 2,000 unit per month, what would be the selling price? So we use this equation, profit equal to total revenue minus the total cost. So profit is 5,000, total revenue is 2,000 units, but we don't know how much we have to sell it for, minus the total cost would be the fixed costs and the variable cost. So that would be 6,000 minus the $2 per unit times 2,000, and that will give you solving the X for solving the X, the equation for X, that will give you X to be 7.5. That's the selling price if we need to make 5,000. All right, well, that's about break-even point. Maybe we could also take a look into where we are in the slides here. So we're going to be back here, and then another concept that we could use to evaluate alternative is the payback period, and this is a simple measure that we could use here. The payback period would be equal to initial cost divided by the annual saving or annual income. So if we have a new machine that costs 2,000, but they will generate a 500 per year, what would be the payback time? How much we have to bring the money back? That would be 4 years. 2,000 divided by 500, that would be 4 years. And then now last question here, or the last thing that I want to talk, sometimes we have to add multiple machines or multiple lines or multiple workers, and that will change the break-even point based on how many machines we use. So this is basically, if we're using one machine, that would be what would be the break-even point. And if we use two machines, of course, more expensive, but maybe because you're serving more customer, you will be able to do a more break-even. So here's what the break-even point for two machines. For example, if we use one machine, there's not going to be a break even, so we have to do whether 2 or 3 in this case. So in order to break even point, that's the for 2 machines, this is what we have to do. We have to produce a quantity of this. However, if we need to have 3 machines running, we have to calculate the break even for 3 machines. So we need to consider how we could make and serve more customers. And I will take an example in just a second here, and maybe in a separate video. But here, what I want you to know about financial analysis, sometimes we look into the financial analysis, the cash flow, which is the difference between the cash received from sales and other resources, and the cash outflow, the paid for labor, material, overhead, and taxes. This is also another financial analysis that we could use to evaluate alternatives. Of course, we need to maximize the cash flow to have more positive cash flow than the negative cash flow. And also another financial measure that we use is the present value, which is using the time value of money, and which considering all the sum and current value of the future cash flow into the proposal. So we consider the interest rate and how long will you will pay the loan, and what's the interest rate, and how long will take you to do the loan. So what I want to do, there's only one thing left in this chapter, which is make versus buy. This is, we did not take an example, so I want to do a video on make versus buy, and another video on a break-even point for multiple machines, and I will show you what we have to do in order to do that. So I'll see you in another video to talk about the make versus buy decision. I'll see you there.